With 2025 now in the books, to say that it was an eventful year feels like an understatement. From the early stages of implementing a new tariff and global trade regime back in the spring, the ongoing Russian and Ukraine geopolitical conflict, to tensions in the Middle Eastern region of Gaza, the market had a lot of variables to digest. Corporate profits globally continued to rise while most central banks around the world cut interest rates, with the US taking the longest to join the monetary easing party. Although the Bank of Canada was among those cutting their overnight interest rates, longer-term bond yields rose modestly in the fourth quarter. This translated to a negative 0.3% return in the last 3 months of the year. For the full calendar 2025, Macco's Diversified Income Fund returned 3.2%. Notably, our investment in the CMLS commercial mortgages, yielding 7%, continues to enhance income distributions, particularly valuable as interest rates begin to decline. Overall, the fund generates a current yield of 4.25%. So the net difference between its current yield and the performance for the year of 3.2% can be attributed to the rise of longer-term interest rates, namely rates 10 years and beyond. The Diversified Income Fund's current yield of 4.3% represents an approximate yield premium of 2% when compared to money market and GIC securities. This income premium remains attractive for low-risk investors seeking income, or those patiently looking for entry points into growth-oriented investment strategies. Entering 2025, central banks were caught between stubborn inflation and slowing growth. But by late in the year, cooling US and Canadian labor markets allowed a pivot toward growth stabilization. Our base case calls for further rate cuts through 2026, with Canada's overnight rate falling to 1.75% by mid-year and 1.5% by year-end, and the U.S. federal funds rate declining toward 3.25% mid-year and 3% by December. This environment favors mid-yield curve positioning as easing policy, elevated sovereign debt, and anchored 2 to 3% inflation increase the likelihood of yield curve steepening. As a result, long-duration government bonds are less attractive, while high-quality investment-grade credit in the 3 to 10-year range offer compelling roll-down potential with lower duration risk. With equity and bond returns now more correlated, income portfolios must broaden beyond just bonds to include corporate credit, mortgage strategies, stable dividend-paying equities, and private lending to deliver resilient cash flow with that downside protection.